Is 2026 recession inevitable? Let's cut to the chase. The question on every investor's mind right now is not if, but when. Or is it even going to happen at all? 2026 is not just a number. It's a year where global economic forecasts collide, risks collide, and investor confidence collides. Let's start with the facts, not the headlines, not the fear-mongering, the hard data from the world's top institutions. First, the growth numbers. IMF's January 2026 World Economic Outlook put 2026 global GDP growth at 3.3%. That's up 0.2% from their October 2025 forecast. Sounds good, right? But dig deeper. IMF's own report calls it resilience with caution. Why? Because that 3.3% is still below the 3.7% historical average from 2000 to 2019. It's slower growth, not no growth. Then there's the UN Conference on Trade and Development. They pegged 2026 growth at just 2.7%, a full 0.6% below the IMF. And the OECD, they cut their 2026 forecast to 2.9% in late March 2026. Why the huge gap? Because the global economy is not a single entity. It's a patchwork. Advanced economies are slowing down. Emerging markets are holding up. But the slowdown is real. Now, let's talk about the recession risk drivers. The number one driver right now is geopolitics. Not just any geopolitics. The Middle East conflict. The Iran conflict specifically. OECD says this conflict is a key drag on global growth. If the conflict escalates and disrupts oil supplies from the Strait of Hormuz, International Energy Agency warns that could trigger a global recession. Why? Because oil prices would spike fast. Oxford Economics says oil hitting $140 a barrel is the mild recession threshold. That would cut global GDP by 0.7%. That's not mild for most people. It's a supply shock. The kind that leads to stagflation, higher prices, slower growth, the worst of both worlds. Second driver, inflation stickiness. We thought inflation was coming down. For the most part, it is. But service sector inflation is sticky. In the US, service prices are still rising at a 4% annual rate. That's well above the Fed's 2% target. In the Eurozone, service inflation is even higher. Why does this matter for a 2026 recession? Because it limits what central banks can do. The Fed can't cut rates aggressively if inflation is still sticky. If they cut too little, growth stays slow. If they cut too much, inflation comes back. It's a no-win situation. Third driver, monetary policy divergence. 2026 is not 2020 or 2021. Back then, central banks were all in on stimulus. Now, they're all over the place. The Fed is talking about rate cuts. But how many? Market expectations are all over the map. Some say 0, some say 3. The ECB is even more cautious. They've pushed back rate cut expectations repeatedly. Emerging markets? They have more room to cut, but they're not a big enough engine to offset the slowdown in the US and Europe. Divergent policy means volatile markets. Volatile markets mean investor anxiety. Anxiety means less spending. Less spending means slower growth. Fourth driver, global growth divergence. Emerging markets like India and Vietnam are growing fast, 4% plus. But they're not big enough to carry the global economy. The US and Eurozone are the big dogs, and they're slowing. US growth is expected to drop to around 2% in 2026. That's down from 2.5% in 2025. Eurozone growth is even weaker, 1% or less. When the two biggest economies in the world slow down that much, a global recession becomes a real risk. Now, let's talk about the recession probability numbers. Because numbers don't lie. Moody's Analytics put the US recession probability at 48.6% as of late March 2026. That's up from 42% in late 2025. And it's climbing. Moody's chief economist says it's likely to top 50% soon. Polymarket, the prediction site, has 2026 US recession odds at 36%, up 12 percentage points from January. JP Morgan says 35%. Goldman Sachs says 30%. All up from just 15% in late 2024. That's a massive shift. Not a single institution is saying no recession. They're all saying risk is rising. Now, let's separate fact from fiction. Is 2026 recession inevitable? No. Is it a high risk? Yes. High enough that you need to prepare. Now, let's talk about what smart investors are doing right now. Not the get-rich-quick crowd. The people who have weathered 2008, 2020, and every downturn in between. First move, protect your cash flow. This is non-negotiable. In a recession, cash is king. Why? Because asset prices drop. Income streams can dry up. You need cash to cover expenses, to take advantage of buying opportunities. Smart investors are building a 6 to 12 month cash buffer, not 3 months, 6 to 12. They're paying down high-interest debt, credit cards, personal loans, any debt with an interest rate above 7%. Because in a recession, high-interest debt is a death sentence. It eats away at your cash flow. It limits your ability to invest. Second move, build a recession-proof portfolio. Not a portfolio that never loses money. A portfolio that loses less and recovers faster. The core of this portfolio is defensive assets. Assets that hold their value when the market crashes. What are they? High dividend stocks. Companies that pay consistent dividends. Utilities. Consumer staples. Healthcare. These are companies that people need, no matter what the economy does. Then, add fixed income, bonds, government bonds, investment-grade corporate bonds. Bonds provide steady income, and they act as a shock absorber for your portfolio. Then, add a small allocation to gold. Gold is not a get-rich-quick asset. It's a hedge against inflation, a hedge against geopolitical risk, a hedge against currency devaluation. 5% to 10% of your portfolio. That's enough, not 20%. 5% to 10%. Third move, embrace long-term themes, not short-term fads. The biggest long-term theme right now is AI, not the AI hype of 2023. The real AI. AI that's moving from software to physical infrastructure. AI that's powering data centers, power grids, cooling systems. This is called AI physicalization, and it's where the real money is. Smart investors are not just buying NVIDIA. They're buying the companies that build the infrastructure AI needs, the companies that make the chips, the cables, the servers, the power systems. Another long-term theme, energy transition, not just solar and wind, battery storage, grid modernization, carbon capture. These are sectors that will grow for decades, not just a few years. Fourth move, avoid common recession mistakes. Mistake number 1, panic selling. When the market drops 10, 20, 30%, don't sell. Selling locks in losses, and you miss the recovery. History shows that markets recover. Always, it's just a matter of time. Mistake number 2, trying to time the market. No one can time the market. Not the experts. Not the billionaires. Not you. Stay invested. Stay diversified. Mistake number 3, ignoring your risk tolerance. If you can't sleep at night because your portfolio is down 10%, you're taking too much risk. Cut back. Adjust your portfolio. Your sleep is more important than any short-term gain. Fifth move, stay informed, but not distracted. Follow the data, not the headlines. The headlines are designed to get clicks. The data is designed to tell the truth. Follow the IMF, the OECD, the Fed, the Labor Department, the inflation reports. These are the sources that matter, not the talking heads on TV. Now, let's talk about the worst-case scenario. If a 2026 recession does happen, what happens to your portfolio? It drops, no doubt about it. But if you're prepared, if you have cash, if you have a diversified portfolio, if you're invested in long-term themes, you'll survive. and you'll thrive. Because recessions are not the end. They're a reset for asset prices, a reset for investor sentiment, a reset for the economy, and for smart investors. Resets are opportunities. Opportunities to buy undervalued assets. Opportunities to build wealth. Opportunities to get ahead. Now, let's talk about the best case scenario. If a 2026 recession doesn't happen, what then? You're still prepared. Your cash flow is strong. Your portfolio is diversified. You're invested in long-term themes. You're still ahead because you didn't take unnecessary risks. You didn't panic. You stayed disciplined. That's the key. Discipline. Not timing, not luck. Discipline. Now, let's wrap this up. Is 2026 recession inevitable? No, but the risk is high. High enough that you need to take action. Action to protect your cash flow. Action to build a recession-proof portfolio. Action to embrace long-term themes. Action to avoid common mistakes. Action to stay informed. If you do these things, you'll be ready, no matter what 2026 brings. Thank you for watching this video. I hope it gave you the clarity and confidence you need to navigate 2026. If you found this content valuable, please hit the like button. It helps the algorithm push this content to more investors who need it. And don't forget to subscribe to my channel. I'm Rich Thinking for Beginners, and I make videos just like this one. Videos that break down complex economic and investment topics in simple, easy to understand terms. Videos that help you make smarter decisions with your money. Videos that help you build wealth, not get rich quick, but build real, sustainable wealth. So subscribe, turn on the notification bell, so you never miss a video. I'll see you in the next one. Keep thinking, keep investing, keep growing.